Hello and welcome to a new video. Today I will show you how to use the Fibonacci tool and especially the Fibonacci extension tool. So in TradingView, which I'm using here, so that's Tradingview.com, the Fibonacci is here on the left hand side. Let me just move it back in frame. This is how it looks like. You open the menu. This is how it looks, Fib retracement, and you can draw it on your, I will just draw it on my charts for once, and then I will show you how to set it up. So once you've just placed it on your charts, you would see this little menu bar here. We click on settings, and what I did is that I activated the Fibonacci extensions, which are 1618, 2618, but it's not as common. 138 is very important, 1764, and we can use the 2. I check reverse, it doesn't really matter. Fibonacci's, as you can see here, are percentage based, so if you use reverse or not, it does not matter. Please don't comment that I'm using Fibonacci wrong. That's not the case. Fibonacci's are percentage based, so you can use them either way. Alright, so the premise of a Fibonacci retracement, or especially the Fibonacci extension tool, is that we are looking for ABC moves. You've probably heard about those. What are ABC moves? So ABC moves describe a trending pattern. The trend starts with the point A, and then we have a wave or a move into our trend direction. When the first trending move is over, we have a point B. Then you will often see which is called a correction wave or a pullback. This then forms the point C, and when the point C is formed and the price resumes into its original direction, we have the point D. Alright, let me mark it for you. So we have A here, and let me just get the color so you can see actually what this means. Then we have B here. The C point is the end of the retracement, very important. And D. Alright, so that is always what we are looking for. And what we are looking for, when we want to draw our Fibonacci tool and use it our Fibonacci extension, we want to look for an ABC move where the C move has formed and the D move is just getting started. So usually it will look something like this, and then we will draw our Fibonacci tool from here, from point A to point B, and we're looking for a confirmed point C. Where's the market turning around? And then we can use our Fibonacci tool to trade into the direction of the trend, because then when the C point is confirmed, the market will often break above this previous B point and continue into the direction of the trend. And then we will use our Fibonacci extension tool to find where is the D point likely going to end, and we can use our Fibonacci extension tool to find trade targets. So sounds complicated in theory. It's quite simple when we use it in real life. So I have defined my trading view here, that this is in my quick menu bar, and here we already have a very nice ABC move at the beginning of the trend, and that's a very good tip if you want to start using Fibs. Start looking at the beginning of a trend. So here, for example, we have an A to B, the C move forms, and then you can see after the C is completed, then the price turns around, it resumes into its original trend direction. We break here above the highs, we have this nice little retest here, and then we continue. So how would we use our Fibonacci extension? When we select it, you click here on the origin, then you drag it to the end of the trend wave of the point 1. Usually you don't need to put it to the wicks, you can do that. What I like to do is look for the most confluence. So in this case it will be here. We can of course also draw it to the wick. So let's do that. If you are comfortable with doing like this, most people prefer this approach, then by all means go for it. So you can see 0 is our A move, 100 is where our B ends, and then C is at 50. You will very, very often see that a C move ends at 61, 50, 38. You don't want to see that a C move goes much, much deeper. This is here, you cannot see it, it's right in the behind the candle, it's 23.6. If the C moves go as low as 23.6, that's usually a trend or a very deep retracement that you want to avoid. So look for the C wave to end at 61.8, 50 or 38.2. Those are very common and those are good retracement levels. then once the level or once the market is resuming into its direction, then you can look for potential targets. With targets, again, you want to use 138.2, 161.8, 176.4, 200 can be used. It is not as common that the price will reach 200. Well, it did in this case, but usually those are the common target areas. And you can see the price moved into 138 very nicely. It moved in 161, then we had a retracement and 176. So the further you target, the less likely the price will reach it. So 138.2 is a very secure target. It's very conservative, but price will reach it easier. 176, it's not as easy to reach. It's much, much further away. And you can often see that before we hit 176.4, the market will sometimes make deep retracements and really challenge you in your trade management. So here we have another very classic example, very clear ABC, and a rule of thumb is that if you are not sure if you are looking at a valid ABC move, then you're probably not looking at one. The good ones really stand out and should jump right at you. So we have ABC, then we break the previous B point, which happens here, and then we continue. So let's see what our Fib says actually. So we are going to use our Fib. Starting point of the trend is here, then the retracement ends here. The trend wave ends here, and then you can see very, very precise, again, very clear, 38.2. And you will see that those Fib retracements, they're often respected very well. There are even traders, which I really don't recommend too much, enter right at those retracements levels. So they will have a pending order at 38.2, or you can go to a lower time frame and time your entry, look for patterns on a lower entry, on a lower time frame as well. But what I want to suggest is that you wait for the break, and then you will see we hit again, we hit all of those areas, 138.2, 161, we make a little pause here, 176, we go on eventually to form a 200, and then the market completely turns around. However, as I said, the 200 is less likely to get hit, but it does happen at times, as you can see. So let's take a look at another example of a very deep retracement. So here is the A move, here is the B, and then we have a C. Let's see what the Fib actually says in this case. So we're going to use it, ABC, the starting point, the retracement ends roughly here, and you can see we are overshooting our 38.2 level, and we are almost making it to 23.6. As I said, it's not a good sign. You don't want to see that a market is actually retracing that deep. You want to see preferably a 50 or 61 because it shows that the market or that the opposition is not as strong. And you can see what happens afterward. The price has a very, very hard time even reaching 138.2. Of course, eventually we hit 176.4 even, but it's very unlikely that you're going to hold through all of this. So you don't want to see too deep retracements here. So here's a little recent example of a, that's the Kiwi and the Swissy. And by the way, you can use this on all time frames, all markets. We had a turnaround here, ABC, a very tiny B, and then here we continue. Let's see what the Fib says about this move. So A, B ends here. And when we zoom in, you can see we have a 50 retracement to the pip. Okay, wait, probably not exactly to the pip if we draw it correctly. Yeah, it's almost perfect, 50 retracement. And you can see we hit 38, we struggle a little bit, and now we're on our way to 161.8, which seems also likely the market is still pushing higher. And you can see how it lines up with natural support and resistance sometimes as well. And it can be used together in conjunction with other price action tools. So I hope you enjoy and have fun with the Fibonacci tools. They can be a great way to add another layer to your trading. Experiment with it, and I'll see you in the next video.